All right, let's talk about Hyatt. You might have seen some headlines about their latest earnings report, and honestly, they're a little confusing. So we're going to dig in and figure out what's really going on with the hotel giant.
Okay, let's just jump right into the big puzzle here. On one side, you see this number, a net loss of $49 million. Ouch. But then, right next to it, you see this one, an adjusted profit of $291 million. So, what gives? Are they losing money or making a ton of it? Well, like a lot of things in business, the real answer is it's complicated.
So here's how we're going to break it all down. First, we'll check out their Q3 report card. Then we'll see how they're building this massive empire. We'll follow the money, of course, unpack their big strategic moves, and then wrap up by looking at what's on the horizon for Hyatt.
All right, let's get into it. Section 1, Hyatt's Q3 report card. We're going to look past those confusing headlines and see the real story of what's happening.
Okay, so here's the most important thing you need to know. That big, scary net loss number, it's not because their hotels are sitting empty. Nope, not at all. Their main business, the day-to-day operations, that's actually growing. The real reason for the loss comes down to some really, really big purchases and strategic moves they've been making. Think of it like a renovation cost. It looks bad on paper for a moment, but it's part of a bigger plan. Which brings us right to our next point, just how they're building this empire. And let me tell you, their growth has been aggressive. I mean, just look at this number, 12.1% net rooms growth in 1 year. For a company this big, that is just a staggering pace. It's not just growth, it's a full-on expansion spree. They're adding thousands and thousands of new rooms to their global map. And this isn't just happening in one place. It's a global push. We're talking more than 5,000 new rooms opened in just the last 3 months. Think about that. They've launched stunning new Park Hyatts in places like Kuala Lumpur and Johannesburg, finally opened their first Hyatt Regency right in Manhattan, and get this, inked a huge deal for 50 brand new Hyatt Studios hotels in China. They are absolutely everywhere.
Okay, so we've seen the building boom. They're expanding like crazy. But what does the money side of things look like? Let's follow the trail and dive into the key financial numbers.
Now, before we go any further, we got to talk about one key term you'll hear all the time in the hotel business, RevPAR. It sounds technical, but it's pretty simple. It stands for revenue per available room. Basically, it's the number one metric that tells you how good a hotel is at filling its rooms and getting a good price for them. You could say it's like the industry's ultimate report card. So how's Hyatt doing on that report card? Well, this chart here tells a fascinating story. If you look abroad, things are on fire. The Middle East and Africa are up a whopping 8.5%. That's fantastic. But when you look at the whole system, it's pretty much flat. And that's because the US market actually dipped a little bit, pulling the average down.
And that brings us all the way back to that other number from the beginning, the $291 million. Remember? That's their adjusted EBITDA. This is the magic number because it takes out all those crazy one-time costs from their big shopping spree. It shows us how the actual day-to-day hotel business is doing. And guess what? It's up 5.6% from last year. So yeah, the core business isn't just fine, it's actually getting stronger. So, you're probably asking, what's the master plan here? This mix of growth, costs, and profits, what's driving it all? Well, that leads us to the real heart of the matter, Hyatt's big strategy. And it's all about betting on the brand, not the buildings. It all boils down to this one key idea. They're going asset light. What does that mean? Well, instead of owning billions of dollars worth of brick-and-mortar hotels, which is super expensive, they want to own the stuff that really makes money, the Hyatt brand name and the lucrative contracts to manage hotels. The McDonald's analogy is perfect here. Hyatt doesn't want to own all the land. They want to be the franchisor, collecting those sweet, steady fees from everyone who does. And if you want to see this strategy in action, look no further than their recent Playa Hotels deal. It's like a masterclass. Step 1, they buy the whole resort company. Step 2, they immediately turn around and sell off the actual physical hotels to a real estate partner. And then, the brilliant part, step 3, they sign these super long-term 50-year contracts to keep managing those same resorts. So they get a big chunk of cash back from the sale, but they lock in decades of management fees. Genius, right? And this isn't just us guessing. You can hear it straight from the top. Hyatt CEO Mark Hoplamazian put it perfectly. He said they're evolving into a brand-led organization focused on, you guessed it, guest experiences and deepening customer loyalty.
The writing is on the wall. For them, the real gold isn't in the real estate, it's in the brand.
So that's the game plan. It's a big, bold strategy. Which leads us to our final question. What does the future hold for Hyatt? What's next on the agenda?
Well, if you look at their own forecast for the full year, it's pretty much a repeat of what we're seeing right now. They're telling investors to expect more of the same. Continued solid growth in rooms, a really healthy adjusted profit, we're talking over $1 billion, and yeah, they're also projecting another net loss on paper as they keep pouring money into this huge strategic shift. And don't forget, it's not all about people sleeping in beds. They've got other powerful ways to make money. They just expanded their deal with Chase for the World of Hyatt credit card. That thing is a cash cow, and they expect it to more than double its earnings by 2027. Plus, they're confident enough in their finances to plan on returning about $350 million to shareholders this year alone. That's a big vote of confidence.
So, when you put all the pieces together, what do you get? You get a company right in the middle of a massive transformation. They're trading pricey real estate for the power of their brand, those long-term management fees, and customer loyalty. Which leaves us with the one big question that really matters. Hyatt is betting everything on its brand, not its buildings. In the long run, will that bet pay off?